Hello, everyone. Welcome back to Buffett Investment Views. I'm Ava, and today we're going to present the timeless wisdom of one of the greatest investors of all time, Warren Buffett. Over the years, Buffett has shared numerous investment principles that have guided him to immense success. In today's video, we'll focus on 5 of the most important investing rules according to Warren Buffett. So grab a cup of coffee, sit back, and let's get started. Buffett started with Buffett Partnership Elite in 1956. From 1956 to 1969, he achieved an average annual return of about 29.5%, significantly outperforming the market. In 1965, Buffett took control of Berkshire Hathaway, initially a textile manufacturing firm, and began its transformation into a diversified holding company. Under Buffett's leadership, Berkshire Hathaway's stock has grown exponentially. From 1965 through 2022, Berkshire's compounded annual gain in per-share market value was approximately 20%, compared to about 10% for the S&P 500 with dividends included. Berkshire Hathaway's market cap has grown from about $18 per share in 1965 to over $500,000 per share by 2023. Investment philosophy. Buffett's investment strategy focuses on value investing, which involves buying undervalued stocks with strong fundamentals and holding them for the long term. He is known for his preference for companies with strong, durable competitive advantages, or moats. Here are Buffett's 6 investment rules that would be useful for anyone starting out in their investing journey.
The first rule in investment is don't lose. And the second rule in investment is don't forget the first rule, and that's all the rules there are. I mean, if you buy things for far below what they're worth and you buy a group of them, you basically don't lose money.
Rule number 1. Don't lose money. Buffett's first rule of investing is simple: never lose money. And his second rule: never forget the first rule. This principle underscores the importance of capital preservation. Buffett is extremely cautious with his investments, always considering the downside risk before the potential upside. He avoids high-risk ventures and prioritizes investments with a margin of safety. This means buying stocks at a price lower than their intrinsic value, ensuring a cushion against market fluctuations. By focusing on not losing money, you ensure that your capital remains intact and can continue to grow over time. This conservative approach has been a cornerstone of Buffett's success and is a valuable lesson for all investors.
The most important thing is to be able to define which ones you can come to an intelligent decision on and which ones are beyond your capacity to evaluate. You don't have to be right about thousands and thousands and thousands of companies. You only have to be right about a couple. I met Bill Gates on July 5th, 1991. We were out in Seattle, and Bill said, "You've got to have a computer." And I said, "Why?" And he said, "Well," he said, "you can do your income tax on it." I said, "I don't have any income. Berkshire doesn't pay a dividend." He said, "Well, you can keep track of your portfolio." And I said, "I only have one stock." I said, and he says, "It's going to change everything." And I said, "Well, will it change whether people chew gum?" And he said, "Well, probably not." And I said, "Well, will it change what kind of gum they chew?" And not. And I said, "Well, then I'll stick to chewing gum and you stick to computers, you know." I don't have to understand all kinds of business. There's all kinds of business I don't understand. But there's thousands of opportunities there. I did understand the Bank of America, you know, and I'll be able. I'm able to do that. I'm able to understand some given percentage. But Ted Williams wrote a book called The Science of Hitting, and in The Science of Hitting, he's got a diagram, shows him at the plate, and he's got the strike zone divided into 77 squares, each the size of a baseball. And he says, if I only swing at pitches in my sweet zone, which he shows there, and he has what his batting average would be, which is 400. If he had to swing at low outside pitches, but still in the strike zone, his average would be 230. He said the most important thing in hitting is waiting for the right pitch. Now, he was at a disadvantage because if the count was 0-2 or 1-2 or so on, even if that ball was down where he was only going to bat 230, he had to swing at it. In investing, there's no called strikes. People can throw Microsoft at me and you know, you name it, any stock, General Motors, and I don't have to swing. And nobody's going to call me out on called strikes. I only get a strike called if I swing at a pitch and miss. So I can wait there and look at thousands of companies day after day And only when I see something I understand and when I like the price at which it's selling, then if I swing, if I hit it, fine. If I miss it, it's a strike. But it's an enormously advantageous game. And it's a terrible mistake to think you have to have an opinion on everything. You only have to have an opinion on a few things. In fact, I've told students, if when they got out of school, they got a punch card with 20 punches on it, and that's all the investment decisions they got to make in their entire life, they would get very rich because they would think very hard about each one. And you don't need 20 right decisions to get very rich. 4 or 5 will probably do it over time. So,
Rule number 2, invest in what you understand. Buffett always emphasizes the importance of investing within your circle of competence. This means sticking to industries and businesses that you know well. For example, if you're knowledgeable about technology, you might focus on tech stocks. If you're more familiar with consumer goods, that's where you should direct your investments. By staying within your area of expertise, you can make more informed decisions and avoid unnecessary risks. Buffett himself avoids industries he doesn't understand well, such as the tech sector. Instead, he focuses on companies with simple, comprehensible business models like Coca-Cola and See's Candies.
I'm looking for durable competitive advantage. I'm looking for something that has a moat around it for a considerable period of time. And I'm looking for an honest and able management to run it because I don't know how to run it myself. And I'm looking for a purchase price that's not excessive. But it's better to pay a little too much for something that's a very good business than it is to buy some bargain, but really a company without much of a future. And I don't know, I don't have a ability to predict with a high probability of success the future of most companies. So I'm looking for the exception. But the nice thing is, if there's thousands of companies out there, I really only have to be right on a couple. I mean,
Rule number 3, look for companies with competitive advantages. Next, look for companies with a durable competitive advantage. Buffett often refers to this as a moat around a business. A competitive advantage can come in many forms: a strong brand, patented technology, a unique product, or exceptional management. Take Coca-Cola, for example. Its brand is recognized worldwide, giving it a strong market position that's hard for competitors to erode. Investing in companies with a solid moat ensures they can maintain profitability and fend off competition over the long term.
well, I've spent my life trying to convince people of investing for the long term. Listen, if I knew how to double my money tomorrow, I'd probably invest for the short term too. It's much easier to invest for the long term if you're just talking pure investment, because you know what's going to, in my view, be very high probability what's going to happen 10 and 20 years from now in a major way, and I don't have the faintest idea what's going to happen tomorrow or next week.
Rule number 4, focus on long-term value. Focus on long-term value, not short-term gains. Buffett is famous for his buy and hold strategy. He believes that time in the market is more important than timing the market. When you invest, look for companies that you would be comfortable holding for decades. This approach minimizes the impact of market volatility and allows your investments to grow through compounding. Buffett's own investment in American Express and his long-term holding of Berkshire Hathaway are prime examples of this principle in action.
If you have a temperament that when others are fearful, you're going to get scared yourself, you are not going to make a lot of money in securities over time in all probability. People really, if they didn't look at quotations, but of course the whole world is urging them to look at quotations, and more than that, do something based on small changes in quotations. But if you didn't, think how much more rational, we've talked about it before, but think how much more rational investing in a farm is than the way many people buy stocks. If you buy a farm, do you get a quote next week? Do you get a quote next month? If you buy an apartment house, do you get a quote next week or month? No, you look at the apartment house or the farm and you say, I expected it to produce so many bushels of soybeans and corn, and if it does that, it meets my expectations. But they buy a stock and they think if it goes up, it's wonderful, and if it goes down, it's bad. We think just the opposite. When it goes down, we love it because we'll buy more, and if it goes up, it kills us to buy more. Ben Graham wrote about it. It's been explained. But if you can't get yourself in that mental attitude, you're going to be scared whenever everybody else is scared. And to expect somebody else to tell you when to buy and therefore get your courage back up or something. I could get this fellow's courage up substantially by saying it's a wonderful time to buy, and then a week from now he'd run into somebody else that tells him the world is coming to an end, and he'd sell. I mean, he's a broker's friend.
Rule number 5. Be fearful when others are greedy, and greedy when others are fearful. This advice speaks to Buffett's contrarian approach to investing. When markets are soaring and everyone is buying, prices are often inflated and risk is high. Conversely, when markets are down and fear prevails, opportunities abound. For instance, during the financial crisis of 2008, while many were selling off their stocks, Buffett saw an opportunity and invested heavily in companies like Goldman Sachs and General Electric. His willingness to go against the crowd has consistently paid off. In summary, Warren Buffett's investing rules are built on timeless wisdom and common sense. By investing in what you understand, seeking companies with competitive advantages, focusing on long-term value, being contrarian, and prioritizing not losing money, you can build a robust and successful investment portfolio.